picture the most profitable bank in India. You're probably, imagining a glass skyscraper in Mumbai, or maybe some slick AI lending app out of Bengaluru.
Right, yeah, the ones that approve a loan before you've even finished typing your name.
Exactly. We are so heavily conditioned to think the future of finance is either gigantic institutional scale or just like frictionless, invisible software.
Yeah, that's the prevailing narrative for sure.
But what if the real money printing machine is actually a dusty branch office in a Tier 3 city? Like holding physical gold jewelry in a safe and sending a guy on a motorcycle to inspect a local wholesale shop.
It's a completely different world.
It really is.
Yeah.
Today, we are looking at a company that finds its edge right on the vibrant, chaotic streets of Main Street, India. We're zeroing in on SBFC Finance Limited. They're an Indian NBSC, non-banking financial company.
Right.
And our mission for this deep dive is basically to figure out how a niche player carves out a highly profitable slice of the credit market, right under the noses of the giant commercial banks.
Yeah, we really need to look at how they make their money, who they're lending to, and, whether this high-growth engine they've built is actually designed to survive a full economic cycle.
Okay, so let's unpack this, because how does unglamorous lending, and we're talking specifically about taking lenses on modest property and gold yield, such intriguing financial numbers? I mean, it just doesn't sound like the kind of disruptive business that generates these kinds of returns.
Well, what's fascinating here is that SBFC's success isn't about inventing a new financial product.
Right.
They aren't spinning up complex derivatives, they aren't pioneering digital tokens, and they definitely aren't trying to change the fundamental nature of debt.
So no blockchain lending here.
No, definitely not. They're executing an incredibly old, deeply traditional product-secured lending against hard collateral.
So,
The competitive advantage lies entirely in where and how they execute it.
which is where, exactly?
They're delivering this traditional structure in underserved, semi-urban Tier 2 and Tier 3 cities. I mean, they are stepping into communities where borrowing against property or gold has happened informally for generations.
Oh, right. So they're basically replacing the local guy.
Exactly. They're replacing the neighborhood moneylender with a formalized, regulated, institutional balance sheet.
Okay, let's get a concrete picture of what that day-to-day operation actually looks like for them. So they are a secured lender,
Yes, 100%.
meaning they're not handing out unsecured corporate paper, and they aren't issuing, those unsecured personal loans based on a quick smartphone scan.
No, if you want their capital, you have to put something tangible on the line.
Right. And they basically run two main products, right?
Yeah. First, you have their secured MSME loans, so micro, small, and medium enterprises. And these are backed by residential or commercial property.
Okay.
And the second is gold loans, which are backed by the physical pledging of jewelry.
And the people walking into these branches, I mean, they aren't tech founders or factory tycoons.
Yeah. Not at all. We are talking about micro enterprise owners, self-employed professionals, local traders, basically working class individuals.
Like the local garments wholesaler or the hardware shop owner on the corner.
Exactly, the independent contractor. And understanding why they target that specific granular customer is the absolute key to unlocking their entire business model.
Because you'd think they'd want bigger fish, right?
Huh.
Why does SBFC intentionally focus on a hardware shop owner in a Tier 3 city instead of, I don't know, a medium-sized manufacturing corporation in Delhi?
Well, the answer comes down to the operational friction that paralyzes large commercial banks.
Friction, how so?
Think about a giant national bank. They rely on standardized processes, algorithmic credit filtering, centralized risk committees. For them, underwriting a 15 lakh rupee loan for a self-employed trader in a semi-urban area is just incredibly difficult.
Because it's messy.
Very messy. The documentation isn't standard. The borrower's tax returns might not perfectly capture their actual daily cash flow.
Right, because a lot of that business might still have cash elements or just irregular income.
Exactly. And assessing the value of the collateral, say, a small commercial property in a bustling local market that requires highly localized knowledge.
Like zoning laws.
Zoning, local disputes, street-level valuations. A big bank looks at that friction. They look at the relatively small 15 lakh rupee loan size, calculate the cost of servicing it, and they just toss it in the too hard pile.
So SBFC is basically building their house in the too hard pile.
That is exactly what they're doing. They intentionally build their entire infrastructure to operate inside that exact pile.
It's like they looked at the institutional blind spot of the big players and said, yeah, we will do the dirty work. It sounds almost like a community moneylender just went to business school, raised a bunch of capital, and scaled up the operation.
That's actually a pretty accurate way to describe it.
But wait, if the model is conceptually that straightforward, like you lend money, you take a lien on a property or hold their gold, and you charge interest, why isn't the landscape completely saturated? Because if there are returns to be made on these 15 lakh rupee loans, why aren't well-funded competitors just swarming these Tier 3 cities and copying this exact setup?
Because while it is conceptually straightforward, operationally, it is brutal.
Brutal in what way?
Let's look closely at the specific collateral dynamics. Take the secured MSME loans. These are typically for business expansion or, long-term working capital.
Okay, so bigger ticket sizes, longer duration.
Right. And appraising that property accurately, ensuring the legal title is clear and unencumbered, which in India, where land records can be famously complex, is a big deal.
Oh, absolutely.
And then you have to set up the localized legal framework required to actually repossess and liquidate that property if the borrower defaults. You cannot execute that from a centralized, air-conditioned office in Mumbai.
You'd need boots on the ground.
Exactly. You need local teams who understand the nuances of municipal records, who know the local legal environment, and who can physically verify the commercial viability of the asset.
Right. I mean, an algorithm sitting on a server somewhere can't tell you if the commercial shop down the street actually gets consistent foot traffic.
No, it can't.
Or if the title to the building is tied up in some decades-old local family dispute, that's going to freeze any repossession attempt in court for 10 years.
Precisely. It requires human judgment and local presence.
Okay, so that's the property side.
Yeah.
And then you have the gold loans on the other side of the portfolio, which seem to operate on a completely different, much faster rhythm, right?
They do. The gold loans serve a distinct and highly complementary purpose within the exact same physical branch. They provide immediate working capital or personal liquidity to essentially the same demographic.
So it's much more short-term.
Very short-term. A customer walks into a branch with family gold jewelry. It gets appraised for purity and weight on the spot by a trained assayer.
Wait, right there in the branch?
Right in the branch. A loan-to-value ratio is applied, and the customer walks out with a bank transfer almost immediately.
Okay.
The combination of these two products allows SBFC to serve the fluctuating liquidity needs of the exact same local household or business owner under one roof.
So they have the slow, steady, larger property loans anchoring the portfolio, and then these fast transactional gold loans providing quick velocity.
Exactly, yeah.
It makes absolute sense from a product design standpoint. But to really grasp why the big banks haven't just bought their way into this segment, we have to look at the exact size and nature of the market SBFC is targeting, because it really is a story of extreme precision over general scale.
Precision is paramount here. I mean, when people read a headline about the MSME credit gap in India, they often imagine the total addressable market as like every single one of the tens of millions of small businesses across the entire country.
Right. You just look at the macro population number.
But SBFC's TAM is incredibly specific. It is not all MSMEs.
Okay.
It is exclusively the subset of MSMEs that require secured, property collateralized financing, and specifically within the 5 lakh to 30 lakh rupees ticket size segment.
That distinction is critical. So they don't want to lend you 50,000 rupees to buy a new laptop for your shop.
Nope.
And they don't want to lend you 5 crore rupees to build a massive new warehouse either.
Exactly. They want that incredibly specific sweet spot between 5 lakh and 30 lakh rupees.
Okay, so why? Why is that specific window the holy grail for their strategy?
Because that ticket size perfectly encapsulates a structural void in the Indian credit market.
Explain that.
Well, below 5 lakh rupees, the fixed operational costs of sending out an appraiser, conducting title checks, and legally registering the mortgage, that will consume your entire profit margin.
Ah, so it's just not worth the paperwork.
Right. For those tiny amounts, it is economically more efficient for a lender to just issue an unsecured loan and price the risk much higher, rather than going through the agonizing hassle of securing property.
That makes total sense. And on the higher end.
Conversely, once a borrower needs above 30 lakh rupees, their business is usually generating enough revenue and is formalized enough with robust tax records and audited statements that the larger commercial banks suddenly become very interested.
So once you hit, say, 35 or 40 lakhs, HPFC comes knocking.
Exactly. The banking giants will swoop in, offer a significantly lower interest rate based on that formal financial data, and win the client. So that 5 to 30 lakh rupees window is the exact zone where the borrower has enough hard collateral to secure the loan, but lacks the pristine, formalized financial documentation to attract the cheapest capital from the mega banks.
Oh, wow. And their internal estimates value this specific 5 to 30 lakh rupees secured MSME market at roughly 3.21 lakh crore rupees.
Yes.
And it's growing at a 24% compound annual growth rate. That is a very healthy, rapidly expanding sandbox to play in.
Very healthy.
It gives them plenty of room to scale without immediately bumping elbows with State Bank of India.
We see a remarkably similar dynamic when looking at how they calculate the TAM for their gold loans, actually.
Really? How so?
Well, their addressable market isn't every single ounce of privately held gold sitting in Indian households.
Right, because that would be an astronomical,
Yeah.
virtually unquantifiable amount of wealth.
Exactly. Their TAM is only the portion of that household gold that can be monetized via formal, branch-led, short-duration lending, and it's constrained by the strict loan-to-value norms set by the Reserve Bank of India.
Ah,
They are targeting households and micro-entrepreneurs who need fast liquidity and are willing to engage with a regulated MBFC rather than just pledging it informally to a local jeweler at opaque rates.
here's where it gets really interesting, though. If there is a 3.21 lakh crore rupees market for these property loans and an enormous pool of household gold, a very significant portion of this market is still stubbornly informal.
Very much so.
I mean, people have been borrowing against their shops, their homes, and their gold for generations, usually relying on local moneylenders, wealthy local traders, or extended family networks. If these informal, highly flexible channels already exist right in their neighborhoods, what is actually driving these borrowers to transition to a formal NBFC like SBFC? Why don't they just stick with the guy down the street who knows their family history and doesn't ask for a CIBIL score?
It's a great question. What we are witnessing is a profound secular shift from informal to formal credit across India.
Okay.
SBFC isn't going out and creating entirely new demand for debt, right? They are capturing existing collateralized demand and migrating it from the informal sector onto a regulated formal balance sheet.
So they're basically intercepting the local moneylender's business.
Essentially, yes. And several macro drivers are forcing this transition. First, you have the ongoing formalization of MSMEs. Small businesses are increasingly realizing the benefits of registering properly and maintaining documented accounts so they can participate in larger supply chains.
Okay, that makes sense. You have to be legit to get bigger contracts.
Exactly. Second, you have the absolute explosion of digital public infrastructure.
Ah, the DPI story.
Yes. The implementation of the GST system and the ubiquitous use of UPI for daily retail transactions are creating robust, unavoidable digital data trails. This makes previously invisible cash flows visible to formal lenders.
Let me be sure I'm picturing this correctly. The local wholesale trader is now accepting UPI payments from his retail customers, right?
Right.
And he has to pay his own suppliers through formal banking channels to comply with GST input credits.
Correct.
Because of that, he suddenly has a verifiable digital footprint that proves his daily income, whereas, 5 years ago, it was literally just cash moving in and out of a wooden drawer.
Exactly. The cash flow is no longer a mystery. And running parallel to that digital trail, you have the steady deepening of credit bureaus.
Right. More people have scores now.
Yeah. More individuals and small businesses now have formal credit scores. As these borrowers become slightly more formalized through GST and UPI, they begin to desire the tangible benefits of a regulated lender.
Like what specifically?
Well, they want clearer, standardized loan terms. They want the potential to access significantly larger loan amounts in the future, which, frankly, a local moneylender can't always provide.
Yeah, the local guy doesn't have infinite capital.
Right. And they want to build a documented credit history that can help them scale their business nationally. But, and this is the key constraint, even with UPI receipts and GST filings, they still don't quite qualify for the strict, fully automated, unyielding underwriting matrix of a Tier 1 commercial bank.
They are caught in a transitional purgatory.
That's a great way to put it.
They are too formal, too ambitious, and require too much capital for the neighborhood moneylender to handle, but they're still too informal, or maybe their documentation is just too quirky for the national bank to touch.
Precisely. And SBFC has positioned itself right there in that transitional middle ground, with open arms and a structured loan product.
The strategic positioning is excellent, but having the right theoretical product and targeting the right transitioning demographic isn't enough to actually win the business, is it?
No, it's not.
Winning over these specific borrowers comes down to one fundamental, capital-intensive operational reality.
Mm.
You have to physically show up in their neighborhood.
Which brings us perfectly to the debate between physical distribution and pure technology.
Let's get into it. Because the competitive landscape SBFC faces is intense, but in very specific ways. Right?
Yeah, very specific.
For MSME loans, the market is highly fragmented. You've got established NBFC peers like Poonawalla FinCorp, Chola Finance, various small finance banks, regional lenders. They're all fighting for overlapping pools of borrowers.
Right.
But then in the gold loan segment, the market is heavily concentrated at the top. It's dominated by massive, specialized giants like Muthoot Finance and Manappuram Finance.
The competitive dynamics are distinct for each product, and it's important to state clearly. SBFC is a niche challenger.
Okay.
They are not the category leader in either MSME or gold loans. They don't have the absolute scale of a Chola Finance, nor do they have the ubiquitous household brand recognition in gold like a Muthoot.
So what's their edge?
Their primary competitive advantage that allows them to win deals against these larger players is their physical distribution network combined with their specific operational processes.
Let's look closely at that physical footprint because the numbers really do tell a story here. As of March 2023, they had built out 152 branches across 120 cities in 16 states.
Yes.
And here is the strategic kicker for you listening. 60% of that business is intentionally skewed to Tier 2 and Tier 3 markets.
Exactly.
They are actively avoiding concentrating their resources in the hyper-competitive, overbanked metro areas like South Mumbai or Central Delhi.
And this physical footprint is absolutely non-negotiable for the specific type of secured lending they are executing.
Why? Can't they just do it through an app?
Let's walk through the reality of issuing a 20 lakh rupees loan secured against a small commercial property in a Tier 3 city. You simply cannot do that purely digitally.
Okay, walk me through it.
The process demands physical proximity. First, it requires local trust. Borrowers in these segments often want to interact with a human being representing an institution before handing over the original title deed to their most valuable family asset.
Right, I wouldn't just mail my property deed to some app.
Exactly. Second, it requires fast turnaround times on property appraisals. You need an empaneled local appraiser who can physically visit the site, understand the local zoning quirks, and assess the true market value quickly.
Makes sense.
Third, and arguably most crucial, you need on-ground collections infrastructure.
When things go wrong.
Yes. If a payment is missed or a business hits a rough patch, you need localized staff who know the borrower, understand the local economic context, and can physically visit the premises to manage the recovery process. You cannot execute that level of high-touch intervention from a centralized call center 1,000 miles away.
I have to push back here, though, and just play devil's advocate for a second.
Sure.
We are living in an era where fintech companies are practically bragging about approving loans in seconds on a smartphone using alternative data and AI.
Right. You see those ads everywhere.
In that context, doesn't a heavy physical branch network with its rent, utility bills, physical security guards, and local staffing costs, doesn't that feel like a dinosaur model? Isn't it just an incredibly expensive anchor weighing down their operating margins compared to a nimble digital lender?
It's a very common criticism and a completely fair question. But in this specific 5 to 30 lakh rupees secured niche, the physical branch is a feature, not a bug.
A feature.
It is the very barrier to entry that protects them from the pure fintechs.
Oh, I see.
Technology and digital sourcing are absolutely used by SBFC. I mean, they use data analytics to filter leads. They utilize digital workflows to speed up processing in the back office. But the technology is merely an enabler. It's an operational tool. It is not the core moat.
So the moat is the physical building and the people inside it.
The core moat is the physical presence combined with their specific approach to customer acquisition, 100% in-house sourcing.
Let's talk about that 100% in-house sourcing because that is highlighted in the sources as a major differentiator.
Yeah.
They do not use third-party direct selling agents or DSAs to find their borrowers.
No, they don't.
Every single loan is sourced by someone who draws a salary directly from SBFC.
That is a critical operational choice, and it directly impacts the quality of their loan book.
How so? Because DSAs are super common in India, right?
Very common. But when an NBFC outsources its sales to third-party DSAs, those agents are typically incentivized purely by volume. They get a commission for every loan application they bring in that gets approved.
Right, so they just want to shove as many applications through the door as possible.
Exactly. This structure naturally leads to a push for volume over quality, poorer initial screening, and historically higher instances of misrepresentation or fraud. The DSA doesn't really care if the loan defaults in year 2, they've already collected their commission.
That's a dangerous incentive structure.
It is. By keeping sourcing 100% in-house, SBFC aligns the incentives of its sales team with the long-term risk parameters of the company.
Because it's their own neck on the line.
Exactly. The relationship manager bringing in the loan knows that if that loan goes bad in 6 months, it negatively impacts their branch's performance metrics, their own compensation, and their job security. It creates a culture of accountability and risk awareness right at the point of origin, before the credit underwriter even opens the file.
It's essentially quality control installed at the front door.
Precisely.
And if you compare their gold loan footprint to the giants like Muthoot or Manappuram, you realize SBFC isn't trying to beat them at the pure gold lending game. Muthoot has thousands upon thousands of branches specifically optimized purely for gold.
Right.
SBFC is using gold as a complementary product nested within their MSME branch infrastructure. It allows them to offer a quick liquidity solution to their existing MSME customers or attract new customers in the neighborhood without having to build a separate parallel gold-only network.
It maximizes the revenue generated per physical branch. I mean, they are already paying for the real estate, the security infrastructure, the branch manager.
Fixed costs are already sunk.
Exactly. By offering gold loans alongside property loans, they improve their asset utilization significantly. They are monetizing the same fixed cost base with 2 distinct countercyclical revenue streams.
Okay, so they have the physical branches situated in the right Tier 2 and Tier 3 markets. They're targeting the right transitioning borrowers, and they're controlling their risk through in-house sourcing.
Right.
But how effectively are they actually turning this elaborate physical setup into hard profit? Let's dive into the yields, the mix, and the unit economics, because this is where the math gets really compelling.
If we connect this operational setup to the bigger financial picture, the core profit engine of any lending NBFC is essentially a spread business.
Buy money cheap, sell it dear.
Exactly. You borrow funds from banks, mutual funds, or bond markets at a certain wholesale cost, and you lend those funds out to your retail borrowers at a higher yield. The difference between those two rates, the spread, is the gross margin that funds the entire operation.
And SBFC's spread is incredibly robust. Looking at the Q4 FY25 figures from our sources, their asset yield, meaning the average annualized interest rate they're charging their borrowers across the portfolio, was an impressive 17.8%.
Yeah, that's high.
Meanwhile, their cost of borrowing, the blended rate they pay to secure that capital from the wholesale markets, was 9.33%. So that creates a gross spread of roughly 8.5 percentage points.
Generating an 8.5% spread before deducting operating expenses and credit costs is a very powerful position to hold. It clearly reflects the pricing power you possess when you serve a demographic that cannot easily access standardized, low-cost, traditional bank credit.
Right, because if these borrowers could go to HDFC and get 11%, they wouldn't pay 17.8%.
Exactly, and this isn't a theoretical margin on a tiny pilot project either. By Q1 FY26, their overall assets under management, or AUM, hit a substantial 11,922 crore rupees.
Over 11,000 crores. That's serious scale.
It is, and the returns they are generating on this expanding base are objectively strong. A return on average assets, or ROA, of 4.53% and a return on equity, or ROE, of 14.73%.
Those return numbers basically prove that the model is highly cash generative at its current scale. But I want to go back to the portfolio mix we touched on earlier, because the mix plays a huge role in shaping these economics.
It does.
The book is split, 79% MSME secured loans and 21% gold loans. Why is this specific roughly 80-20 balance so strategic for them?
It's a highly synergistic mix that balances risk, return, and liquidity.
Break that down.
Okay, so the MSME secured loans making up the dominant 79%, they are the core earnings engine. They offer higher nominal yields, and crucially, they sit on the balance sheet for a longer duration, often several years. This provides steady, predictable, compounding interest income over time. However, as we discussed, they require high operating intensity. detailed property appraisals, rigorous underwriting, and active continuous collections monitoring.
Right. They are the heavy lifting that builds the durable, long-term franchise value.
Exactly. Now, the 21% allocation to gold loans acts as the perfect operational and financial counterbalance to that.
Because it's faster.
Yes, gold loans recycle cash much faster because they're typically short duration, often 6 months to a year. And they involve significantly lower credit friction.
Friction like repossessing a house versus a gold chain.
Exactly. Think about the mechanics of default. If a borrower defaults on an MSME loan, the legal process under the Sarfisi Act to repossess and sell a property can take years in India, tangled in local courts.
Yeah, that's a nightmare.
But if a borrower defaults on a gold loan, SBFC already has the physical gold sitting in a vault right there in their branch. The recovery process involves a straightforward, highly liquid public auction.
So they just sell the gold and get their money back.
Pretty much. So the gold loans improve the overall liquidity profile of the NBFC. They provide cleaner, faster incremental returns, and they require less complex underwriting, while the MSME loans drive the durable long-term yield.
And as they scale this specific mix across their branch network, we are seeing the tangible benefits of size. Their cost-to-AUM ratio improved, dropping from 4.65% down to 4.19% in FY26.
Right.
But wait, help me visualize that. If they're paying rent on 150-plus buildings and salaries for hundreds of local in-house agents, how is that cost mathematically shrinking as they grow? Aren't they just duplicating that expensive infrastructure everywhere they expand?
Well, it shrinks relative to the size of the revenue base. Think of a single branch in a Tier 3 town.
Okay.
The day it opens, it has fixed costs: rent, electricity, a branch manager, security. If that branch has originated, say, 5 crore rupees in loans, those fixed costs represent a huge percentage of the income. But 3 years later, if that exact same branch, with the exact same rent and the exact same manager, has now built a localized book of 25 crore rupees, the fixed costs haven't quintupled.
Oh, I see.
They've stayed relatively flat while the interest income has exploded. As the total size of their loan book, the AUM, gets bigger, the fixed costs of paying for the entire network are being spread out over a much larger revenue base. Every incremental rupee of loan dispersed from an existing branch pushes a higher percentage of profits straight to the bottom line.
So what does this all mean for you as a listener trying to evaluate the business? Let me summarize the fundamental math here. SBFC borrows money at around 9%. They lend it out at almost 18%. They pocket that roughly 8.5% difference. They are growing their loan book aggressively, and their fixed operating costs are shrinking as a percentage of that expanding book.
That's the formula.
On paper, it sounds like an unstoppable money-printing machine. But, that impressive spread isn't pure profit. It has to cover the branch network, the staff, and most importantly, it has to absorb the cost of the loans that inevitably go bad.
That transition is exactly why we need to rigorously check under the hood of their financial health.
Yeah.
Because in the lending business, you can manufacture incredible top-line growth and high apparent yields very easily if you are willing to lower your standards and take on mad risk. The true, enduring test of any financial institution is the resilience of its balance sheet when tested by economic adversity.
Let's start by looking at their safety buffer then. Their capital adequacy ratio is reported to be very high, sitting comfortably between 31.7% and 32.0%.
Right.
For context, that means they have a significant amount of their own equity capital backing their loan book. They aren't running on financial fumes. They are exceptionally well capitalized to absorb potential shocks or unexpected losses.
A 32% capital adequacy ratio is a very strong, conservative, defensive posture, well above the regulatory minimums. However, you have to balance that metric against their leverage profile.
Okay, what does the leverage look like?
Their gross debt stands at 53.2 billion rupees against an equity base of 31.9 billion rupees.
Yeah.
That translates to a debt-to-equity ratio of roughly 166.7%.
Wait, so they have strong capital adequacy to absorb losses, but they are also carrying a substantial amount of debt to fund their operations. How do we reconcile that tension? Is that a contradiction?
It's not a contradiction. It's a classic structural feature of a fast-growing, non-deposit-taking NBFC.
Right, because they don't take savings accounts like a normal bank.
Exactly. They have more than enough equity to satisfy regulators and absorb modeled credit losses, which is why the capital adequacy is high. But to fund their rapid AUM growth, to continuously write thousands of 15 lakh rupees loans across 16 states month after month, they have to constantly borrow immense amounts of money from external sources.
From where?
They rely heavily on wholesale bank loans and issuing non-convertible debentures or NCDs to institutional investors. Their growth engine is externally funded, which means they are perpetually exposed to the pricing, availability, and sentiment of wholesale funding markets.
They are essentially acting as a gigantic financial pipeline. Money flows in from the large commercial banks and bond markets at wholesale rates and flows out to the MSMEs at retail rates.
That's a good way to look at it.
But if the inflow gets more expensive, due to macroeconomic factors, their margins get squeezed immediately.
Instantly.
But let's look at the other side of the risk equation. The borrower's actually paying them back. Let's look at asset quality. Their gross non-performing assets, or GNPA, is holding relatively stable at 2.61%.
And a 2.61% GNPA for a lender specifically targeting the self-employed, semi-formal segment is actually quite respectable.
Really?
Yes, it suggests that their secured lending model, their insistence on hard collateral, and their in-house sourcing discipline are currently keeping gross defaults within manageable bounds. Furthermore, their provision coverage ratio, or PCR, is sitting between 41.6% and 46.2%.
I have to stop you right there.
Uh-oh.
If you're listening to this and you've invested in fintechs or unsecured personal lenders before, hearing a 42% provision coverage ratio probably just set off alarm bells in your head.
Definitely.
In those businesses, you want a PCR of 70% or 80%. If a local recession hits, a 42% PCR means they haven't explicitly set aside cash reserves for more than half of their identified bad loans. Why isn't that a glaring red flag here?
It's a vital, critical question, and it really cuts to the heart of their accounting and their business model.
Because it sounds low.
In an unsecured lending business like personal loans or credit cards, a 42% PCR would be terrifyingly low. You would want it much closer to 80% because an unsecured default is often a total unrecoverable loss.
Right, the money's just gone.
But SBFC is predominantly a secured lender. If a borrower defaults on an MSME loan, SBFC holds a legally enforceable claim on a residential or commercial property.
Oh, right.
The fundamental assumption baked into a 42% PCR is that they will eventually recover a significant portion of the remaining outstanding loan value by liquidating that underlying collateral.
So they don't need 80% coverage because the house is the coverage.
Exactly. The primary risk isn't necessarily a 100% loss of principal. The real risk is the agonizing time, the legal brain damage, and the operational cost it takes to actually repossess and sell property in the Indian judicial system, particularly in a Tier 3 city where local politics might interfere.
And there's a highly specific data point in the sources we need to monitor regarding exactly this type of stress. A Q1 FY27 summary highlighted a 70 basis point increase in 0+ DPD stress.
Yes.
Now, DPD stands for days past due. This metric tracks borrowers who are even one single day late on their scheduled payments. And this uptick in stress was specifically isolated in the sub-10 lakh rupees segment of their portfolio.
Which raises a profoundly important question about the granular composition of their borrower base.
What does it tell us?
A 70 BPS rise in early-stage delinquency, isolated specifically in the sub-10 lakh segment, tells you a very clear macroeconomic story. It indicates that the smallest ticket borrowers, the microenterprises with the thinnest profit margins and the smallest cash income buffers, are feeling the economic pinch first. It sharply highlights the inherent vulnerability of the self-employed borrower's cash flow. While the secured property theoretically protects SBFC from ultimate loss upon liquidation, it does absolutely nothing to protect the borrower from struggling to make their monthly interest payment during a localized demand shock or, say, an inflationary spike in raw materials.
It's the classic canary in the coal mine. It shows that while the overall corporate machine is humming and producing great headline numbers, the lowest, most economically sensitive tier of their customer base is starting to sweat.
Exactly.
So knowing these precise stress points, the structural reliance on external wholesale debt funding, and the cash flow vulnerability of their smallest borrowers, how does management actually plan to keep this aggressive growth engine running without tipping the scales into dangerous territory? Let's look at their playbook for the future.
Well, management's ambition is certainly not modest. Their stated public goal is to double their total assets under management in the next 3 to 3.5 years.
Double it. Wow.
To mathematically achieve that, they are aiming to sustain a relentless 5% to 7% quarter-over-quarter growth rate. That is aggressive compounding, and executing it flawlessly over 3 years is a monumental task.
Doubling an 11,922 crore rupees loan book in roughly 3 years requires serious operational scale. But what I found most interesting in the sources is where this growth is not coming from.
Oh, yeah.
They aren't pivoting the business model. They aren't launching wild new unsecured personal loans. They aren't suddenly moving into corporate lending. The playbook is remarkably focused and disciplined.
Extremely focused.
It's coming from deeper geographic penetration, specifically strengthening their roots in South and West India, and crucially, maximizing the yield from their existing branches rather than embarking on an expensive new branch rollout.
It's a strategy centered on density and efficiency. They only plan to open 10 to 15 new branches in the near term.
That's almost nothing.
Right. They clearly realize that aggressively expanding into completely new, unfamiliar states carries high operational and credit risk. You don't know the local property dynamics, you don't know the local political environment for recoveries.
Yeah, India's too diverse for a one-size-fits-all rollout.
Exactly. Instead, they want to squeeze more productivity, more loans, out of the 152 branches they have already paid to set up. This is a very sound, almost boring strategy, and in lending, boring is usually a high compliment.
Boring is beautiful.
Deepening penetration in an existing customer base, in a geography you already thoroughly understand, costs significantly less than acquiring a brand new customer in a virgin market.
And a critical part of this density strategy is repeat borrowing. They want to aggressively upsize loans for existing proven customers.
Yes.
Think about it. If a local trader took a 10 lakh rupees loan 3 years ago, made every single payment on time, and paid it back flawlessly, SBFC wants to be the institution that gives them the 20 lakh rupees loan today to open a second location.
The economics of repeat borrowing are unbeatable. You already know the customer, you have historical data on their actual payment behavior through an economic cycle, you've already verified the property title and established the mortgage.
Half the work is done.
Exactly. The credit risk profile of a seasoned repeat borrower is dramatically lower than a new walk-in, and the customer acquisition cost is near zero. For an NBFC, capturing the repeat business of a growing MSME is the most profitable growth vector available.
Alongside this physical density, they are also pushing to improve the quality of their digital sourcing funnel. They're aiming to have 90% of their newly acquired customers possessing a formal credit score above 700.
Which is a fascinating evolution of their model.
How so?
They're operating in the semi-formal sector, a segment historically defined by a lack of traditional credit data. But as the Indian financial system formalizes and bureau coverage deepens, they are aggressively using data analytics to skim the highest quality borrowers within their specific niche.
So they get the cream of the crop.
They are using technology to filter the top of the funnel, ensuring that by the time a human relationship manager spends time on a physical appraisal, the borrower already meets a high baseline of documented creditworthiness.
I have to push back here, though. We are looking at a plan to double AUM in 3 years. Can they realistically achieve that scale just by squeezing more juice out of the same geographic oranges?
It's a fair challenge.
At some point, don't you saturate a Tier 3 town? Don't you eventually run out of 700 score borrowers who have clean property titles and need exactly 15 lakh rupees in that specific district?
That is the fundamental execution risk embedded in their guidance. Management is making a structural bet that the shift from informal money lenders to formal NBFCs is a deep enough, wide enough well to sustain that aggressive growth without forcing them to lower their underwriting standards to hit volume targets.
They think the well hasn't run dry yet.
They believe their specific secured market is still vastly underpenetrated by organized, regulated players.
This highly ambitious growth target brings us right to the edge of what could go wrong. The market is pricing in a lot of flawless execution over the next 3 years. What keeps the skeptical investors, the bears, up at night?
Well, every high-growth lending story, no matter how well run, has structural vulnerabilities, and SBFC is no exception. The bears look at this model and see 4 distinct intertwined risks that could derail the compounding machine. The first, and arguably the most significant over a full cycle, is cyclicality and the resulting spike in credit costs.
Right, we touched on this when discussing the sub-10 lakh rupees stress. SBFC's core borrowers, the self-employed traders, the local MSMEs, they operate in the real economy with very thin income buffers.
Very thin.
They don't have access to corporate treasuries, commercial paper markets, or massive lines of credit to fall back on.
Yeah.
If India's broader MSME cycle weakens, if inflation spikes input costs, or if local consumer demand drops, these smaller ticket borrowers will be the very first to default on their loan payments.
This raises an important question about the lag effect of credit costs, which is a classic trap in financial analysis.
Explain the trap.
In the lending business, rapid loan growth acts like a camouflage net over your true asset quality.
Oh, because the denominator gets bigger.
Exactly. When you are growing your loan book by 25% or 30% a year, a huge, disproportionate chunk of your overall portfolio is brand new, and new loans rarely default in the first 6 to 12 months. They simply haven't had time to season.
Right.
Let's track a cohort of loans originated in January 2024. They will look pristine in June 2024. So, your gross NPA ratio looks artificially low and healthy because the denominator, the total size of the loan book, is inflating rapidly with unseasoned, untested risk.
Wow, that's tricky.
The true unvarnished test of SBFC's underwriting discipline will only become visible when their growth inevitably slows down, and these enormous new vintages are forced to season through a less forgiving economic cycle.
It's exactly like riding a bicycle uphill. As long as your funding costs stay low and you are pedaling fast-generating rapid growth, the forward momentum keeps you upright. Your bad loans look small in the rearview mirror compared to your massive new originations.
That's a perfect analogy.
But if you hit a patch of gravel, say, a sudden recession hits the self-employed sector, or funding dries up, gravity kicks in incredibly fast, the momentum stops, and those previously hidden, unseasoned loans suddenly start going bad all at once.
That's exactly how the balance sheet dynamics work. And the second risk, spread compression, acts like a severe headwind on that uphill climb. Currently, SBFC enjoys a very healthy 8.5% gross spread. But as the MSME sector continues to formalize, the larger, more aggressive banks and bigger NBFCs are actively moving downstream to find yield.
Right, think of their profit margin like a block of wood in a vise. On one side, the big commercial banks are tightening the jaws by offering cheaper loans, forcing SBFC to lower their rates to compete. On the other side, the wholesale bond market is tightening the jaws by raising the cost of borrowing. If both sides squeeze, SBFC's profit vanishes. Because SBFC targets modest credit borrowers, their pricing power has a hard, practical ceiling. They can't just hike rates indefinitely to protect their margins if larger competitors are undercutting them.
The asset-liability mismatch in repricing speed is a constant threat. If macroeconomic conditions tighten and wholesale interest rates rise, SBFC's cost to borrow that 53 billion rupees of debt will go up.
Instantly.
And crucially, it will likely go up much faster than they can legally or practically reprice their existing long-term MSME property loans. Their spread compresses automatically, purely due to market mechanics.
Nice.
And woven through all of this operational and market risk is risk number 3, regulatory and RBI risk.
Right, they aren't operating in the Wild West.
No, they are a regulated financial entity. The Reserve Bank of India closely and strictly monitors NBFCs. Any sudden changes in supervision rules, increases in capital requirements, or specific targeted changes to loan-to-value limits on gold lending could instantly stall their growth engine.
Just with the stroke of a pen.
If the RBI decides the MSME credit sector is overheating and proactively mandates higher provisioning requirements across the board, SBFC's reported profitability takes an immediate, unavoidable hit regardless of their individual underwriting quality.
The bear case is essentially a scenario of cascading correlated failure. Funding gets expensive, which squeezes margins. The broader economy slows, which spikes defaults among the self-employed. The competition prevents them from raising rates to cover the losses. And the sheer speed of their prior growth means a huge volume of loans go bad simultaneously.
That is the nightmare scenario.
Navigating a path between that severe bear case and their highly ambitious growth targets comes down entirely to who is actually steering the ship. Let's look at the people pulling the levers. Who is running this company?
The governance and ownership structure of SBFC is quite distinct in the Indian context. As of March 2026, the promoter holding stands at a majority 52.35%.
Okay.
However, this isn't a traditional, sprawling, family-run Indian conglomerate. It was originally backed and built by financial sponsors, specifically sophisticated private equity firms like Arpwood and Claremont.
That's a crucial distinction for you listeners to understand. It means the company operates as an institution rather than a founder-dominated empire where the CEO's last name matches the company name and strategic decisions are made at the family dinner table.
And this institutional setup has tangible, measurable benefits for minority shareholders. Looking at the exhaustive IPO documents and subsequent regulatory disclosures, they have a remarkably clean regulatory history.
That's refreshing.
There were no SEBI or stock exchange disciplinary actions noted at the time of their IPO. Furthermore, there was no obvious evidence of promoter pledging.
Why is pledging a big deal?
It's a very common and dangerous red flag in Indian midcaps, where founders use their company shares as collateral for personal or other business loans. When the stock drops, they get margin called, and it creates a death spiral.
Ah, so none of that here.
None noted, no.
It looks clean, professional, and structured on paper. The capital allocation strategy also deeply reflects this institutional private equity-style discipline. They are heavily, almost exclusively, skewed toward reinvesting their profits directly back into organic loan growth.
Yes.
They aren't getting distracted by flashy, overpriced acquisitions, and they aren't bleeding essential capital out of the business through massive premature dividends. They are ruthlessly feeding the compounding machine.
The institutional nature is undeniably a positive for clean governance, efficient capital formation, and strategic focus. However, there is a missing piece in the puzzle, and it's a significant one for long-term evaluation.
Yeah.
While they have executed brilliantly during this recent phase of high growth and benign credit conditions, we do not have a proven public track record of this specific leadership team navigating a severe multi-year credit crisis as a listed entity.
I have to ask, is it a feature or a bug that the promoters are financial sponsors rather than a traditional multi-generational banking family?
That's the million-dollar question.
Right, because a private equity firm is fantastic at instilling rigorous financial discipline, optimizing the balance sheet, and preparing a company for a successful IPO.
They are very good at that.
But a traditional banking family might have deep generational memory of how to survive a localized famine, a currency devaluation, or a systemic liquidity freeze. When the credit cycle aggressively turns, you want operators who have managed bad debt collections in the mud, who know how to negotiate with distressed borrowers locally, not just spreadsheet optimizers sitting in a boardroom.
That is the exact nuanced debate the market is having right now regarding their long-term resilience. The financial sponsors have built a truly fantastic, highly efficient lending platform, but the ultimate test of any lender is time and adversity.
True.
Have they truly built a culture of conservative underwriting discipline that permeates all the way down to the individual branch manager in a Tier 3 city? Or have they just built a very efficient, highly incentivized sales machine during a benign economic cycle?
We won't know until the tide goes out.
Exactly. They are transitioning toward more day-to-day operating control, resting with the professional management team rather than the passive sponsors, which is absolutely the right evolutionary step for a mature NBFC, but the true test of that management team's mettle remains ahead of them when the cycle inevitably turns.
Okay, let's bring this all together. We've covered a lot of ground today, diving deep into the nuts and bolts of Indian credit. We started by asking a simple question. How does SBFC Finance carve out a highly profitable slice of the market right under the noses of giant trillion-rupee banks?
And the answer is that they have built a highly profitable, precisely targeted spread business by focusing relentlessly on lending 5 to 30 lakh rupees to the self-employed transitioning fabric of Main Street India.
And they execute this not through algorithms alone, but by leveraging a physical network of 152 branches in Tier 2 and Tier 3 cities to secure tangible property and gold as collateral.
Right.
They intentionally fill the operational high-friction gap that large commercial banks find too difficult and too expensive to cross. The financial result is striking. They borrow at around 9%, lend at roughly 18%, and are driving significant operating leverage as their loan book scales toward their highly ambitious goal of doubling AUM in 3 years.
But as we explored in the bear case, the risks are real and structural. They rely heavily on external wholesale debt funding. Their borrower base possesses very thin income buffers to weather economic shocks, and their recent hypergrowth means a large portion of their loan book is completely unseasoned. The ultimate long-term success of their institutional management team will depend entirely on maintaining strict underwriting discipline when the inevitable economic slowdown hits, and not chasing volume just to satisfy growth targets.
It is a classic story of operational execution. The addressable market is clearly there, the growth spread is currently there, but lending at its core is ultimately a business of managing risk through cycles, not just driving loan disbursement volume in the good times.
Well said.
I want to leave you with one final provocative thought to mull over, building on everything we've discussed today. We've seen that SBFC's entire competitive moat relies heavily on physical branches and human interaction.
Yeah.
It's built on the trust of borrowers who are transitioning from informal neighborhood money lenders to the formal system. But think about this trajectory. As India's digital public infrastructure grows exponentially, as GST footprints, UPI transaction trails, and algorithmic cash flow analysis become perfectly predictive of a small business's daily health, will the requirement for a physical property pledge and a local branch manager become obsolete?
It's a huge question.
If underwriting becomes 100% digital, instantaneous, and based purely on verified real-time cash flow rather than a brick-and-mortar mortgage, does a 152-branch physical network remain an unassailable asset, or does it slowly turn into an incredibly expensive, outdated anchor? Keep questioning the numbers behind the narratives. Thank you for joining us on this deep dive. See you next time.